Welcome to the deep dive. Today, we're pulling back the curtain on Alexandria Real Estate Equities, ticker symbol ARE.
Mhm.
Is this undisputed pioneer in life science real estate, a landlord poised for the future? Or is its current market price reflecting, well, a difficult past, maybe a relic of that high interest rate world we've been in?
It's a really interesting tension there, isn't it?
It is. We're diving in to uncover why this specialized leader is trading at such a significant discount and, frankly, what's holding it back from its true potential.
Yeah, you've got this company right at the forefront of a high-demand, very specialized real estate niche. But then pushing against it is this challenging capital markets environment.
Right.
So our mission today really is to dissect AIR's fundamentals, its strengths, its strategic position, its financial health, all based on the source material we've got. And we're anchoring this analysis as of June 20th, 2025.
Absolutely. So we're doing a deep dive into Alexandria Real Estate Equities, Inc. It's an S&P 500 company, a regulated investment trust, a REIT laser-focused on the life science sector. We'll be pulling out the key insights from our source material to really get to the bottom of this. Okay, let's kick things off with Chapter 1, Business Analysis, the bedrock of innovation.
So Alexandria isn't your, let's say, average office landlord, right? How would you describe their core business?
No, definitely not average. RZME operates as an urban office REIT, sure, but with this highly specialized focus. They create these collaborative mega-campus ecosystems.
Megacampus, okay.
Yeah, and these aren't just buildings. They're really tailored environments, specifically for life science, tech, that's agricultural technology, and advanced tech industries. They provide, mission-critical infrastructure, kind of the backbone for R&D.
Okay, mission critical. So given how specialized that sounds, I imagine the revenue isn't just like standard rent checks. How do they actually make money from these unique properties?
Well, the primary revenue is rental income, mainly through long-term triple net leases.
Triple net.
Exactly.
Yeah.
The tenant pays taxes, insurance, maintenance. It
Mhm.
insulates Alexandria from those variable costs, provides very stable, predictable cash flow. But what's really unique, I think, is their venture capital arm, Alexandria Venture Investments.
Oh, right.
They started that way back in 1996. It makes strategic equity investments in transformative life science companies. And this creates this really powerful symbiotic relationship.
How so?
Give them deep industry insight, for one, and also a direct pipeline of future tenants for their actual properties. Pretty smart.
So it's definitely not just four walls and a roof. What kind of specialized products or services are they actually offering inside these campuses?
Right, it's way more than that. Their main product is highly specialized Class AA plus office and lab space. Think complex features. Reinforced floors for heavy gear. Advanced HVAC for precise climate control. Beefed up electrical grids with backup power. Specific utility hookups.
Wow, okay.
These aren't just, nice extras. They create incredibly high barriers for competitors to even enter the market. And maybe more importantly, huge switching costs for tenants. Imagine the disruption and cost of moving a complex lab setup.
Yeah, you wouldn't want to do that often. It sounds like they're building more than just facilities, really emphasizing this whole ecosystem concept with the mega campus developments.
Exactly. That ecosystem creation is key. These are curated environments. They have amenities, programming, all designed to foster collaboration, spark innovation, and crucially, help their tenants attract and retain top scientists.
Makes sense.
They talk about their four-pillared approach: real estate, venture capital, thought leadership. They have the Alexandria Summit, and corporate responsibility. It really integrates them deeply into the life science world.
And their market position, are they really the leader here?
Oh, absolutely. Undisputed pioneer. They basically created the life science real estate niche back in '94. Unparalleled brand recognition, 3 decades of experience. And they're huge.
How huge?
Market cap, near $29 billion. Almost 40 million rentable square feet in North America as of March 31st, 2025. That scale alone is a major edge, especially since the portfolio is concentrated in what they call AAA innovation cluster locations.
Like Boston, San Francisco.
Exactly. Greater Boston, the Bay Area, San Diego, the key hubs.
So their main value proposition isn't just space, it's building the innovation hubs themselves.
That's it. Exactly. Creating and curating these ecosystems. It's encapsulated in their cluster model, built on location, innovation, talent, and capital. For the tenants, that means a competitive edge, access to talent, and really high retention. Look at Q1 2025, 89% of their leasing activity was from existing tenants renewing or expanding.
That's sticky. Okay, let's talk about the industry itself. What are the big long-term growth drivers for life sciences that RE is tapping into?
Well, the sector has some powerful long-term tailwinds. You've got the aging global population, naturally rising healthcare spending, incredible scientific progress, think genomics, personalized medicine,
Right.
plus the integration of AI and machine learning into drug discovery. That could seriously drive demand for advanced computational labs. And don't forget the post-pandemic reshoring of biomanufacturing. There's over $250 billion in U.S. investments announced for that.
Okay, strong tailwinds. But I've heard there are some short-term bumps in the road for 2025. What are the immediate headwinds AE is facing?
There definitely are headwinds right now. The market's seeing what some call a supply supercycle.
Meaning?
It's a mix of new ground-up development plus a wave of office buildings being converted into labs. It's pushed the national lab availability rate up to around 30%.
30%, wow.
Yeah. And at the same time, biotech funding has gotten tougher. So tenants are being more cautious. This combo creates a more tenant-favorable market, which is, frankly, a new dynamic for this sector, and it's directly hitting Alexandria's near-term outlook.
And competition. Who are they really up against? Other specialists or are traditional office guys jumping in?
It's both. They have specialized peers like Biomid Realty and Half-Peak Properties. But yeah, increasingly, diversified office REITs like Boston Properties, Kilroy Realty, they're converting underused office space into labs.
Interesting dynamic. You mentioned their PE earlier, around 96x, looks high.
Right. But PE is often misleading for REITs because of non-cash depreciation charges. What investors really look at is the dividend yield. And ours is pretty healthy, around 7.39% as of June 2025.
That's a solid yield, especially given the regulations they operate under. What are some key rules affecting a REIT like R?
It's layered. As a REIT, they have to distribute 90% of taxable income as dividends. That's a big one.
Okay.
Then their tenants are heavily influenced by FDA approvals and NIH funding levels, so shifts their impact demand. And for R itself, environmental regs are increasingly important, like greenhouse gas limits in cities. They actually committed to net zero operational carbon by 2040, partly in response.
So what makes it so tough for new players to break into this specialized market? Is there a real moat here?
Oh yeah, there are significant barriers, a strong moat. First, it's incredibly capital intensive. Building specialized labs costs a fortune.
Right.
Second, you need highly specialized expertise. Understanding complex HVAC, hazardous materials, specific tenant needs, it's not simple office space. Third, prime land in those AAA innovation clusters. Super scarce and expensive.
And relationships.
Exactly. Alexandria has decades of established relationships across the life science ecosystem. Universities, VCs, big pharma. New competitors just can't replicate that overnight.
Sounds like their competitive advantages are pretty solid. Can you just sort of synthesize what really sets them apart?
Sure. It's the preeminent brand strength being the pioneer counts for a lot. Significant cost advantages from their scale, that almost 40 million square feet helps. Plus, they're actively cutting G&A costs this year. Powerful network effects from the Megacampus strategy. Success breeds success, attracting more talent and companies. Extremely high tenant switching costs for those specialized labs. And unique assets like irreplaceable locations and that Alexandria Venture Investments arm, which creates this self-reinforcing growth loop. It finds and funds future tenants.
Okay, here's a key question for investors right now. With all this office-to-lab conversion flooding the market, how durable is that competitive advantage? Is their moat holding up?
Yeah, that's the critical question. It's definitely being tested. Alexandria's response is what they call a flight-to-quality strategy.
Meaning they're focusing on the best properties.
Exactly. Doubling down on their premium Class AA plus Megacampus properties. They're basically letting the converters fight over the lower end of the market. It's a calculated bet that sophisticated life science tenants will always gravitate towards the best environments, the best infrastructure, the best ecosystems for their critical work.
Makes sense. Let's shift gears slightly and move on to Chapter 2. Management evaluation. How do you assess the leadership? Have they steered the ship through storms before?
Leadership seems strong, characterized by a long-term vision. That's largely shaped by founder Jonas Marcus, who's still the executive chairman, and the current CEO, Peter M. Moglia. And yes, they have a proven crisis playbook.
Like during the financial crisis.
Exactly. 2008, they battened down the hatches, preserved capital, then strategically built up their development pipeline for the recovery. During COVID, they kept essential labs running, showed strong corporate citizenship, and actually ended up revising guidance up as demand held strong.
So it's kind of a two-step. defend, then attack. And it sounds like they're in step one now, given the market.
Precisely. The current focus on cost control, selling non-core assets, that's the defensive step one. They're positioning themselves for the eventual pivot back to growth when conditions improve. Their reputation helps too. They consistently win awards for transparency, like Narayat's Investor Care Gold Award, and Newsweek named them one of America's most trustworthy companies 3 years running.
Okay, what about capital allocation? Where's the money going, and how are they funding growth?
The primary investment is definitely that capital-intensive development pipeline. As of Q1 2025, there was about $2.4 billion in remaining costs on those projects. They're projecting spending between $1.5 and $2.1 billion just for 2025.
Wow, that's a lot. How do they pay for it?
A key part of their strategy is self-funding through value harvesting, basically selling off non-core assets. They got $1.4 billion from sales in 2024 and are targeting almost $2 billion, $1.95 billion for 2025.
And how do they return cash to shareholders? Dividends, buybacks?
Both. They do share buybacks, repurchased about $208 million in Q1 2025. But the big story is the dividend. They've increased it for 16 straight years.
Impressive consistency.
Yeah. The annualized dividend is $5.28 per share for Q2 25, yielding around 7.4% right now. And it's well covered. The FFO payout ratio was a healthy 55% in Q4 2024.
Got it. Now, you mentioned return on invested capital. ROIC has fluctuated and declined recently. For many companies, that's a red flag. What's the story for R?
Yeah, you can't just look at the headline number. ROIC was about 0.94% in 2024, maybe 2.1% TTM Q1 25. That looks low.
Right.
But it's a direct result of pouring billions into those new development projects before they generate income. It's classic short-term pain for long-term gain. This isn't wasted money, it's investment in future cash flow. As these big projects come online and start paying rent, you'd expect that ROIC to jump significantly. That's where the value unlocking happens.
That context is crucial. Okay, let's put some numbers on the table now in Chapter 3, Financial Analysis. What's their current market cap?
As of June 20, 2025, Alexandria's market capitalization stands around $12.6 billion. So definitely a large cap REIT, major S&P 500 component.
And revenue growth. Historically strong, but you mentioned a recent slowdown.
Yeah, history's robust. $1.89 billion in 2020, up to $3.12 billion in 2024. But Q1 2025 showed a slight dip, 1.4% down compared to Q1 24. It really signals that those market headwinds, the supply, the cautious tenants are starting to bite into the top line. Now, for profit margins in REITs, you want to look at the property-level operating margin. For RE, that's strong, around 70%, shows the core real estate is highly profitable. Net margin jumps around a lot because of non-cash things like venture capital gains or losses, impairment charges.
Yeah.
It's not the best gauge of core profitability here.
Okay, property level is key. What about free cash flow? Usually important, but maybe different for REITs.
It is different. Traditional free cash flow can look low or even negative because of all the development spending. TTM FCF for Q1 25 was about $208 million, but that was down 39% year over year because of those high CapEx numbers. A much better metric for REITs is adjusted funds from operations, AFO. That's a closer proxy for their actual distributable cash flow.
Right, AFO. So what does that tell us about earnings and the outlook?
It tells us they generated $9.47 per share in 2024. But here's the key point reflecting the headwinds. They revised their 2025 guidance downward to between $9.16 and $9.36 per share.
Ah, that's significant.
It is. It's a real departure from their usual consistent growth track record. It shows the severity of the current market challenges hitting occupancy and net operating income growth. But despite that 25 revision, the longer-term trend in adjusted FFO per share is still strong and steadily upward, from $7.30 in 2020 to that $9.47 in 2024. And financially, they maintain a moderate debt-to-equity ratio between 0.55 and 0.78, and importantly, investment-grade credit ratings Bay1 from Moody's, BBB+ from S&P. That supports their whole fortress balance sheet strategy.
I noticed some different numbers floating around for their current ratio, which usually signals liquidity. What's the deal there for a REIT?
Yeah, that can be confusing. Some sources might show a higher number, but typically for REITs, it's low, often below 1.0. That's normal. They fund long-term assets like buildings with long-term liabilities like debt. Their real liquidity buffer comes from massive undrawn credit facilities, about $5.3 billion available as of Q1 2025. Plenty of flexibility.
Okay, so liquidity isn't the concern the ratio might suggest. And the dividend?
Rock solid. 16 straight years of increases, well covered by FFO, as we said.
So putting all this financial data together, what does it imply for valuation? That PE ratio still looks crazy high at 96x.
Right. Ignore the PE for REITs. It's misleading due to depreciation. The key metric is price to funds from operations, PFFO.
Yeah.
Based on that revised 2025 guidance, RE is trading at a forward PFFO of roughly 7.7 times.
7.7x, that sounds low.
It does. It suggests significant undervaluation compared to its cash-generating ability. Some might even call it an information arbitrage opportunity for investors who understand REIT accounting versus just looking at GAAP earnings.
And for intrinsic value, we typically look at a discounted cash flow model, a DCF. Using AFFO instead of free cash flow, what does an educational model suggest?
An educational DCF model performed for this report estimates an intrinsic value range of roughly $85 to $105 per share.
Okay, $85 to $105 compared to a current price around $71.37. That's quite a gap.
It is. The key assumptions there are a weighted average cost of capital, WACC, between 7.0% and 7.5%. That considers the 10-year Treasury yield around 4.38% and Ares beta of 1.30. And growth rates that factor in the slight AFFO dip in 2025, then moderate 3-4% medium-term growth, and 2.0% perpetual growth. That 2025 AFFO guidance cut really anchors the near-term assumptions.
Okay, we've dug into Chapter 4, market sentiment. What are the Wall Street analysts saying? Price targets.
Analysts seem cautiously optimistic, actually. The average 12-month price target is around $97.31. That implies potential upside of, 37% to over 60% from where it's trading now.
Wow, significant upside potential baked in there. What's the consensus rating? Buy, sell, hold.
It's generally a moderate buy or hold. Suggests they see the underlying value, but are maybe hesitant about the near-term headwinds pushing performance.
And the media tone. Is it echoing that cautious optimism, or is it more focused on the challenges?
It's pretty mixed. Leans a bit cautious. You'll see headlines acknowledge when they beat FFO estimates, but then they quickly pivot to the negative, the downward revision for 2025, lower occupancy concerns, higher interest expenses. The overall narrative is often high-quality company, but navigating a tough, uncertain market.
What about market indicators? Short interest?
Technicals. Short interest is moderate, around 4% of the float, not excessively high. But technically, the chart looks quite bearish. The stock's been consistently trading below its 50-day and 200-day moving averages. And importantly, the 50-day recently crossed below the 200-day. That forms a death cross.
Ooh, death cross. Sounds ominous.
It's considered a strong, long-term, bearish technical signal by chart watchers.
So that's a really stark disconnect, isn't it? Fundamentals suggesting undervaluation and analyst targets pointing way up, but the technical picture looking pretty grim. What explains that gap?
It really is a classic case of the macro environment just overwhelming the company specifics right now.
Meaning interest rates.
Primarily, yes. It suggests the market is being driven by top-down factors. High interest rates punish the entire REIT sector, almost regardless of individual company strength. The market isn't really rewarding R for its specific strengths or long-term growth prospects at the moment. It's pricing in the sector-wide rate risk.
Fascinating disconnect. Okay, let's look inside the company structure with Chapter 5, ownership structure. Who actually owns R? Is it concentrated?
Yes, ownership is highly concentrated among big institutional investors. We're talking 96% to 98% of the shares are held by institutions.
Like who?
The usual suspects. The Vanguard Group is the largest, with about 15%. BlackRock has over 10%, so you have a very stable institutional shareholder base. The flip side, of course, is if one or two of those giants decided to trim their position significantly, it could create real selling pressure.
Makes sense. What about insiders? Are the execs loading up on shares, signaling confidence?
Insider ownership is meaningful, somewhere between 1.2% and 1.6%. There has been some net positive buying activity recently. Reports show 14 buys versus 3 sells.
That sounds positive.
Well, context matters. Many of those buys were non-open market transactions, potentially related to tax planning or stock grants. What you don't see recently are large, discretionary open market purchases by the top executives. So maybe interpret that as more neutral to cautious on the near-term outlook from their perspective.
Got it. Time to face the potential downsides. Let's explore Chapter 6, risk assessment. Can you walk us through a quick SWOT analysis, starting with Ares' key strengths and internal weaknesses?
Sure. Strengths are pretty clear. Market leadership, that irreplaceable portfolio in AAA innovation clusters, high-quality cash flows over half from investment-grade tenants, long leases around 7.5 years average, plus the fortress balance sheet and experienced management.
Okay. Weaknesses?
Internally, the biggest weakness is probably concentration risk. Being so focused on specific geographies in the life science industry makes them sensitive to downturns in those areas or in, say, the biotech funding cycle. Also, their growth model is capital intensive. That $2.4 billion still needed for development creates execution risk and definitely drags on near-term free cash flow generation.
Right. Now, looking outward, future opportunities and external threats.
Opportunities are linked to those long-term trends. Secular growth in life science, AML driving new lab needs, biomanufacturing coming back onshore. The current tough market might also allow for opportunistic acquisitions if competitors stumble. And their capital recycling program, selling assets to fund growth, is a way to create value.
And threats.
External threats. Definitely the competitive supply from new builds and those office-to-lab conversions we talked about that pressures occupancy and rents. Capital markets volatility is huge, especially high interest rates, which directly impact their funding costs and property values. And then there's just the inherent volatility of the life science industry itself. Tenant bankruptcies or funding pullbacks are always a risk. And digging into those macro factors, elevated interest rates are probably the #1 issue right now driving the stock's underperformance. That 10-year Treasury at 4.38% significantly boosts R's cost of debt, and the discount rate used to value real estate. It just hits REIT valuations hard.
Even with triple net leases protecting from some inflation.
Triple net helps, but sustained high inflation could still squeeze margins eventually, even if tenants pay most operating costs.
And what about specific geopolitical factors? The prompt mentioned the U.S. imposed tariffs of 2025. How do those play into R's risks?
Right, the tariffs under the America First trade policy, they hit ARE in two ways. Directly, construction costs go up due to tariffs on imported materials, affecting their development pipeline.
Okay, makes sense.
But the bigger impact might be indirect, hitting their tenants. Life science companies rely on global supply chains for things like APIs, specialized equipment. Tariffs increase their R&D and manufacturing costs. That could strain tenant budgets, maybe delay leasing decisions, and potentially increase default risk for Alexandria down the line. It's a ripple effect.
That's a significant indirect risk. Okay, let's pull all these threads together now in Chapter 7. Conclusion. The road ahead. Can you quickly summarize the core bullish arguments for Alexandria?
The bull case rests on that unmatched market position. The durable cash flows from high-quality tenants and long leases, the strong balance sheet, proven management. Plus, you have that attractive 7.4% dividend yield and what looks like a compelling valuation based on PFFO metrics.
And the key bearish points that are clearly weighing on the stock.
The bears point to the challenging current market, that supply surge, the revised FFO guidance signaling slower growth. The acute sensitivity to interest rates is undeniable. Negative market sentiment and those bearish technicals like the death cross don't help. And then you layer on the geopolitical risks via tariffs impacting tenants, plus the capital-intensive nature of their growth. And to reiterate the valuation piece, despite all those headwinds, our educational DCF model still suggests that intrinsic value range of $85 to $105 per share. That remains significantly above where the stock is trading today, around $71 to 37 cents.
So a neutral wrap-up might be: Alexandria is fundamentally a high-quality company, a leader in its niche, but it's trading at a discount primarily because of severe macroeconomic headwinds, especially those high interest rates. The market seems laser-focused on that macro risk right now, maybe overlooking the company's underlying strengths.
That sums it up well. It feels like a catalyst might be needed for the market price to start reflecting that underlying value again. And that catalyst is likely external.
Like the Fed cutting rates.
Exactly. A pivot from the Federal Reserve towards a lower interest rate environment would likely be the biggest single factor to help lift RE and the whole REIT sector.
Okay, so here's the final thought for you, the listener. What stands out to you from this deep dive? For a patient, long-term investor who believes in the future of life science and anticipates an eventual shift in interest rates, maybe R presents a compelling value case right now. But if you're focused on near-term momentum, the technicals certainly warrant caution. What do you think it will take for the market to shift its gaze back to RE's fundamentals? If you enjoyed this deep dive and want more analysis like this, remember to like this video and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority requests for deep dives on specific tickers. And over the next few months, we're actually planning to cover all of the S&P 500 stocks exclusively for our members.
And just a reminder, as always, this analysis was generated by an AI system. It's for educational purposes only and should definitely not be taken as financial advice. Always do your own research, or better yet, consult with a qualified financial advisor before making any investment decisions.